Welcome to a quick revision of financial statements of companies. This is chapter 11, unit 1 of your CA Inter Advanced Accounting syllabus. To begin with, provisions of Companies Act regulate how financial statements are prepared for a company. The provisions which are applicable are section 128, which mentions how the books of accounts have to be maintained, section 129, which mentions how the financial statements have to be maintained, section 133, which tells the accounting standards which are applicable in preparation of financial statements. The other sections which are there in this chapter and this unit is 123 and 124, which talks about dividend, which we'll see slightly later. That's like the part 2 of this discussion. When we talk about section 2 subsection 35, which defines the dividend, this is also seen along with 123 124. Talking about financial statements, this definition is actually given under section 2 subsection 40. We'll see that also when we discuss 128, 129 and 133. To begin with, section 128 of Companies Act 2013. In detail, you learn it in your company law syllabus, but in accounts, you need to know two important points which is given under section 128 of Companies Act 2013. What is it? Whenever an entity prepares its books of accounts, it has to prepare in compliance of two important points. Number one, double entry system. Can the entity follow single entry system? No, it has to be double entry. Second point, it has to be under accrual method of accounting. It can't be based on cash system. In fact, this accrual method is a fundamental accounting assumptions that you read in accounting standard 1. As an entity, you have to follow accrual. If you don't follow accrual, a specific disclosure has to be made under section 129 subsection 5 for deviation accounting standard 1. Come on, let's go forward. After this, 128 other provisions are not needed for accounting. Let's go to 129. 129 talks about financial statements. However, the definition of the word financial statements is given in section 2 subsection 40 of Companies Act 2013. It will include balance sheet, statement of profit or loss, cash flow statement, notes to accounts, any other significant accounting policies is in the definition. In this chapter 11, unit 1, we'll only talk about balance sheet and statement of profit or loss. Cash flow statement or accounting standard 3 is second unit of this same chapter, which will be discussed in a separate discussion altogether. Now, talking about section 129, subsection 1, two important points that you should remember. Number one, when you prepare financial statements, it should be in compliance of accounting standards. These accounting standards are actually given under section 133 of Companies Act 2013. NFRA has been authorized. NFRA has mentioned the same accounting standards which are issued by ICAI are applicable to corporate entities also. So section 133 mentions or specifies the accounting standards which are to be followed in preparing financial statements. The next point is Schedule 3. Schedule 3 of Companies Act 2013 prescribes the form and content of balance sheet and PL which has to be followed by every entity. This Schedule 3 format does not apply to banking companies. It does not apply to insurance companies. It does not apply to electricity companies. Why? For these three sets of companies, there is separate regulatory body, separate act which regulates and issues a separate financial statement format which needs more disclosures than our Schedule 3. So because that is more intensive, more exhaustive and more disclosures, they follow that and they don't follow Schedule 3. Other than banking, insurance, electricity entities, everyone has to follow Schedule 3. Sir, I like to do horizontal. Can I do? You cannot. You have to follow vertical form of balance sheet if you are a company. Now, the next point that you should notice, if you are doing consolidated financial statements because you have a subsidiary, to holding and subsidiary, same provisions of section 129 and Schedule 3 are applicable. The point that we need to notice 129 subsection 5. I told you all the accounting standards which are applicable, which we already discussed under applicability of accounting standards. I hope you remember there's an amendment also on this starting from September 2025. So such applicable accounting standards to the entity based on its class, they have to follow everything. Can they not follow accounting standards? No, you have to. If in case you don't follow accounting standards in preparation of your financial statements, as per section 129, subsection 5, you have to make following disclosures. What are the disclosures? Number one, what is the deviation from accounting standard? Number two, what is the reason why you are deviating from accounting standard? Number three, what is the financial impact because of such deviation? Meaning, if you had followed the accounting standard, this would have been the number. Because you did not follow accounting standards, this is the number. So the difference has to be disclosed outright openly in the financial statements whenever there is any deviation from accounting standards. Next point to notice, the format of preparation of balance sheet. We'll always write the balance sheet first and then the PL because part 1 of Schedule 3 talks about balance sheet. part 2 of schedule 3 talks about statement of profit or loss, and this balance sheet is prepared as on a specific date, not for the period, whereas statement of profit or loss prepared for the specific period. Balance sheet is divided into two parts, not liabilities and assets. It's called equity and liability side as well as asset side. Under equity and liability side, it's further divided into four parts: shareholders funds, share application, money received pending allotment, non-current liabilities and current liabilities. On the asset side, it's divided into two parts: non-current assets and current assets. Talking about shareholders funds, the classification is further three items: share capital, reserves and surplus, money received against share warrants. Money received against share warrants, in September 2025 exam, there was a small question. Question number 2 had an adjustment. Usually this item doesn't come, and if it comes, you write it. And share application, money received pending allotment never has been given as an item in the trial balance. What I want you to know is, you don't have to write all the items in your balance sheet format. It has to be written only if it is given in the trial balance, or in that question if that item is there, write it in the answer. If not, you can skip that item. It's not like 2 is share application, money received pending allotment, 3 is non-current liabilities. No. If in case in one of the questions, if there is no share application, money received pending allotment, then one will be shareholders fund, two will be non-current liabilities. You can immediately write that. Got it? Under non-current liabilities, we have four items: LDOL, long-term borrowings, deferred tax liability, other non-current liabilities, and long-term provisions. Under current liabilities, you have four items: STOSS, short-term borrowing, T, trade payables, O, other current liabilities, S, short-term provisions. Asset side, the classification is into only two: non-current and current. Under non-current, you have P and DLO. P, property, plant and equipment; N, non-current investments; D, deferred tax asset; L, long-term loans and advances; O, other non-current assets. Further, under property, plant and equipment, we have tangible, intangible. Tangible asset under construction, capital WIP; intangible asset under development. Four items to be disclosed separately. Coming to current assets, the classification is CIT-CSO. C, current investments; I, inventory; T, trade receivables; and then C, cash and cash equivalent; yes, short-term loans and advances; O, other current assets. By this, we finish our balance sheet format. Let's talk about disclosure requirements, because in this chapter, the questions are not computation based. Questions are presentation based. You will not get marks for getting the balance sheet tallied. You will get marks for presenting the items at the right place. You get marks for disclosing the values at the right value. Talking about disclosure requirements, talking about share capital, you have to always disclose the authorized share capital separately. Then issued, subscribed, called up. Always write called up capital. From the called up capital, read up the calls in arrears if any to find the paid up capital. Don't directly write the paid up capital. What appears in the outer column, what is taken as the total, what is posted to balance sheet is paid up. But how do we find paid up? Write called up, deduct calls in arrears if there is any. And next, always disclose types of shares separately if there is equity and preference. Always also disclose the class of shares separately. These are shares of 10 each fully paid up. These are shares of 10 each 5 rupees paid up. These are shares of 5 each fully paid up. These are shares of 10 each fully paid up. You need to disclose the classes of shares separately. Very important disclosure is, if in case during the, if there is any shares issued for non-cash consideration like bonus issue, conversion of debentures or preference shares, or purchase of an asset against which shares have been issued, disclose that separately. Not disclosing it might still tally your balance sheet, but you won't get full marks. There are a couple of other disclosure requirements also. Shareholder holding more than 5% to be disclosed separately, but not required for our exam. For exam, 3 points. 1, authorized type, class, nominal value to be disclosed separately. Calls in arrears to be deducted from called up to find paid up. Shares issued for non-cash consideration to be disclosed separately. Share capital part done. Let's go to the second part, reserves and surplus. Reserves and surplus, we need to show any addition to reserve, any deduction from reserve, any appropriation of reserve, any transfer of reserve to proposed dividend, any transfer of P&L reserve to general reserve, all of it separately. Capital redemption reserve, security premium, debenture redemption reserve, general reserve, P&L account, capital equalization fund, dividend equalization fund, workman compensation fund, all of them separately. Share options issued or share options outstanding to be disclosed as a separate line item. If in case during the year P&L account has negative balance, basically debit balance, it should be shown under reserves and surplus only. If there is any accumulated losses, show it under negative number. Preliminary expenses or any unamortized expenditure. Ever since Companies Act 2013 has come, there is no space in the asset side. It has to be written off completely in the very first year. If this is not the very first year also, because you are preparing question, if they give preliminary expense, write it completely from reserves and surplus. I hope you got it. Any other point that I missed? I think we have covered everything. Accumulated losses can be negative. Reserves and surplus is one notes to accounts whose value can be negative in the balance sheet. All other items will be usually positive. Share application money received pending allotment. If it is there, you please write it. Calls in advance and interest on calls in advance will be other current liabilities. Don't call it as share application money received pending allotment. Then non-current and current. How do we classify whether a liability is current or non-current? This is not based on only 12 months. We need to check the operating cycle subject to minimum of 12 months. From the time we purchase the raw material till the time we sell the finished goods and receive the money, whatever the time taken is called as operating cycle. You will take operating cycle or 12 months, whichever is higher. Whichever is higher becomes the basis. If an asset's useful life gets exhausted within that basis, current. If it goes beyond the basis, non-current. If a liability is settled within that basis, current. If the liability will be settled beyond that basis, non-current. So the basis is operating cycle subject to minimum of 12 months. And when they don't really give you so much data, you can assume one borrowing as long term or short term, up to you. Now, talking about borrowings, how to decide whether it is long term or short term? Based on that operating cycle subject to minimum of 12 months. You need to disclose borrowings from bank, borrowings from related parties separately. You need to mention, is it secured or is it unsecured? You should mention, is it hypothecated against any specific asset? Is any asset specifically hypothecated for this loan? If there is any current maturities of long-term borrowings, it should not be included in long-term borrowings. It should be shifted to short-term borrowings. Previously, there was a place where this was shown under other current liabilities. In the May 26th edition of ICAI study material, there is a specific MCQ which tells what is the treatment of current maturities of long-term borrowings. In that option is short-term borrowings. So remember this one small thing. Don't do a mistake here. You might find some RTPs wherein they've written in other current liabilities. It's now clarified by the institute very clearly. You would have to write it under short-term borrowings only. Note this very point. And then if there is any interest accrued but not due, accrued and due, it cannot be included in borrowings. Doesn't matter short or long. Interest is not loan. Interest is other current liability. Loan taken is short-term or long-term borrowing. So if they tell wrongly included interest accrued and due, wrongly included interest accrued but not due, deducted from the borrowing, write it separately as other current liability. You need to disclose how much of it is good, how much of it is bad with regard to your borrowing. Then we are done with this. Then any other long-term liability, you need to show how much is it borrowing from MSME and how much is it from other than MSME. This is requirement as per schedule 3, but anyways we don't have any questions on this. Provisions also not much. With regard to trade payables, be careful. Whenever we say trade payables, we should tell and include only payable for goods. Outstanding expenses is not trade payables. If you buy asset from somebody, against that asset you have payable, that is also not trade payables. Trade payable is goods purchased and money outstanding. It is not asset purchased, money outstanding. It is not expense not paid outstanding. It is only goods purchased and money outstanding. And you need to disclose the aging. How much is up to 1 year, 1 to 2 year, 2 to 3 year, greater than 3 year, you should disclose. But usually in the questions, they won't ask you this classification in trade payable. They'll ask you this classification only in trade receivable. Talking about the next aspect, current liabilities. Don't include current maturities from long-term borrowings. Now it's been clarified very clearly. We'll include it in short-term borrowings only. If there is any unpaid dividend, it will come here. Applications received and rejected and due for refund will come in other current liabilities. If application is received, neither rejected nor accepted will come as a separate line item. Share application money received pending allotment. That interest accrued and due, accrued but not due, all of them will come here only. With regard to tangible assets, asset side, disclosure requirements are as per accounting standard 10. You should disclose how much is the original cost, how much is the accumulated depreciation at the beginning, how much is the current year depreciation, how much is the closing accumulated depreciation. From original cost, deduct the closing accumulated depreciation to find the WDV of the asset. If there is any revaluation, disclose it separately. If the asset is hypothecated against any liability, disclose it separately. And what is the method or policy followed? Cost model, revaluation model. What is the method of depreciation followed? All of that have to be disclosed. With regard to property, plant and equipment, which is included in tangible assets. And we will not do one separate notes to accounts for depreciation and amortization expense. When you prepare tangible asset, intangible asset notes to accounts for balance sheet, in that current year depreciation or current year amortization column total will only be posted to our depreciation amortization expense in our statement of profit or loss. Intangible asset also exactly same like tangible assets, but their AS10, here AS26 based disclosure requirements. Then talking about investment, we should classify current, non-current. If they tell, good. If they don't tell, you can assume and then disclose. With regard to loans and advances, if there is any advance tax or GST credit, include it in loans and advances. If there is any prepaid expenses, include it in other current assets. Then with regard to inventory, we need to show how much is raw material, how much is WIP, how much is finished goods, how much is goods in transit separately. If there are any loose tools, it has to be checked for PPE definition. If it fulfills PPE definition, AS10. If not, it will be written as inventory. And stores and spares also should be disclosed separately. Talking about trade receivables. Trade receivables will be bills receivable and debtors. This will be for goods sold to customers only. Trade receivables cannot include prepaid expenses. Trade receivables cannot include our money receivable on sale of the asset to somebody. You sold your asset to somebody, they owe you money. That's not trade receivables. That will be other current assets. Trade receivable will be only for goods. Trade receivables will be only for. You need to show how much is good, how much is bad. Provision, if any, though it's a liability, it should be deducted from trade receivables. And you have to disclose the aging schedule. What is aging schedule? Outstanding for up to 6 months, 6 months to 1 year, 1 year to 2 year, greater than 3 years, secured, unsecured. All this has to be given for trade receivables. Last item in the balance sheet, cash and cash equivalent. This will include balance with bank as well as cash in hand. When you say balance with bank, you need to show how much is it with scheduled bank, how much is it with unscheduled bank. If it is demand deposit, okay. If it is time deposit with bank, you need to show what is the time deposit which is for more than a period of 12 months. What is the time deposit for a period less than 12 months? And if there is money in earmarked bank accounts, like your escrow account or something, that also needs to be disclosed separately. A point to be noted here is overdraft in bank balance. Overdraft account will not be shown as cash equivalent. Cash cannot be negative. That will be shown as borrowing or it will be shown as other current liability. I hope you got it. Then this cash and cash equivalent here is slightly different from cash and cash equivalent in our accounting standard 3. They are not the same. Then coming to statement of profit or loss, two parts. Part 1 is income. Part 2 is expense. Income side, there are only two items: revenue from operations and other income. In revenue from operations, we write sale of goods or rendering of services. If there is any sales return, it should be deducted from sales before you write it as revenue from operations. You might have done in your PU or schooling. Sales, you write credit side. Sales return can be deducted from sales or can be written on the debit side. Here we don't have debit credit. Sales return has to be deducted from sales only. Other income, any other source of income. Discount received, commission received, sale of asset profit, insurance claim received, everything is other income. Are you getting it? Then coming to expenses. Under expenses, cost of material consumed, purchase of stock in trade, changes in inventory, employee benefit expense, finance cost, depreciation, other expenses, the classification. Change cost of material consumed. This will be applicable only for manufacturing entity. For a non-manufacturing entity, you buy goods, you sell goods, you trade, you don't consume. So consumption of material will not come. Consumption of material will come only in the case of manufacturing entity. And when you say consumption of material, we're not talking about finished goods. We're not talking about WIP. We're only talking about raw material. How do we compute consumption? Opening raw material plus purchase of raw material minus closing raw material. Opening raw material plus purchase of raw material minus closing raw material. I hope you understood. The next one is purchase of stock in trade. In the case of purchase of stock in trade, this applies in trading entity only. If you buy raw material, it's not written as purchase of stock in trade. Purchase of raw material is including consumption. If you buy and sell finished goods, it will come in purchase of stock in trade. I hope you got it. Then this purchase of stock in trade should be net of purchase return. If there is purchase return, deduct it and then only write this. Then the next one is changes in inventory. When you talk about inventory and changes in inventory, we are not talking about raw material. Raw material changes, opening minus closing, is already considered in cost of material consumed. So when we say changes in inventory, it will be only for WIP and finished goods. Work in progress and finished goods, opening minus closing is done here. Remember, not closing minus opening. Opening minus closing. Because in your trading account, opening stock will come on the debit, closing stock will come on the credit. Debit side represents the expense side. Here, this debit or expense side, we are writing changes. So closing is shifted to debit side. So it will become opening minus closing. It's not closing minus opening. This specific item changes in inventory can appear as negative in our statement of profit or loss. Only item other than net profit which can appear negative in statement of profit or loss is changes in inventory. I hope you understood. And this purchase of stock in trade plus changes in inventory together will give us COGS or adjusted purchase. Why? COGS is found as opening plus purchase minus closing. Opening minus closing changes in inventory. Purchases plus. So if they give it together, you should identify how much is opening minus closing. You should identify how much is purchases and write them separately. If in case you can't identify, put one flower bracket and for both of them you can write one together. You've done one master question. I'll put an I card for that in this specific part. Whoever has not done that question, you can click on the I card here and then do that. That's one master question on financial statements, which has lot of adjustments, including rectification of error, capital reserve adjustment, and adjusted purchase adjustment. Beautiful question, master question. If you have not done, everyone should do. If you have done, very good. July 2021 examination question. Though old, yet take gold. Then employee benefit expenses, will write all employee benefit expenses, salaries, wages, everything, whether paid or not. Important to note that. And the finance cost will include interest costs. And depreciation will not prepare a separate note. We'll take it from our tangible assets and intangible assets column. Any other expense, discount allowed, bad debts, provision for bad debts created, or any other expenses will all be written under other expenses. Understood? Petty expenses, postage, telegram, all of this. Then if in case they give some wages paid for installation of asset and everything, don't write them in employee benefit expenses. You would have to add it to the cost of the asset. You should remember other standards and concepts that you learned in preparation of financial statements. You can't take it lightly. Then by taking total revenue, deducting total expense, we'll get profit before exceptional and extraordinary items. Then we have to add or deduct exceptional item, find profit after exceptional but before extraordinary items. And extraordinary items, once we deduct, we'll get profit before tax. Then you'd have to deduct tax. This exceptional items and extraordinary items we'll discuss in detail in accounting standard 5, and it's not part of this discussion. So if you revise AS5, you'll understand what is exceptional, what is extraordinary. What is part of the ordinary course of operations is ordinary. What is distinct from the ordinary course is extraordinary. Exceptional items are actually ordinary, but based on size, incidence, and nature, it will be considered as exceptional. Extraordinary items, exceptional items, prior period items need separate disclosure in financial statements as per AS5. So schedule 3 also accommodates such separate disclosure. And talking about tax, we'll find it before tax, and then we deduct two taxes. One, current tax. Second one, deferred tax. Deferred tax we learn in accounting standard 22. By way of a recent new amendment in accounting standard 22, which is applicable for January 2026 attempt and onwards, very recently issued RTP includes one new item called top up tax. For May 2026 edition, whatever the study material which is issued by ICAI does not include this change. It is issued by RTP. And the upcoming materials, whatever the ICAI will reduce, I don't know, for Jan 27 when they release the new bunch of material, in that this will be added. It is called top up tax. It's an amendment applicable for January 2026 examination and onwards. So if you've done accounting standard 22 taxes on income and you don't know top up tax, I'll put the link of that iCard here. You can watch this video. This is not applicable for September 25 exam and before. Newly introduced for Jan 26 and onwards. Will be taught to you people together when we do accounting standard 22 taxes on income. Right now 22 not done, top up tax not done. Beautiful concept. I love it. You can read it later. Then we'll get profit or loss from continuing operations. As per accounting standard 24, is there any profit from discontinuing operations? Add or deduct that. Then we'll find profit totally for the year. And we'll write EPS, both basic and diluted EPS as per accounting standard 20. By this, we finish preparation of our financial statement. What I want you to note whenever we prepare financial statement is, first, when they give question on P&L and balance sheet together, first you would have to find net profit or net loss. And after you find net profit or net loss, if it is net profit, on that you compute provision for tax. That provision for tax should be written under short-term provisions. Then our balance sheet gets closed completely except reserves and surplus. That profit after deducting tax, whatever is there, will be returned to reserves and surplus. When we close our reserves and surplus, we'll post that balance to balance sheet and then the balance sheet will tally. Ta-da! Important point to note when you're approaching financial statement based question in examination is, remember, the first page of your answer book will be always balance sheet. I'll show that before I tell it. sorry. Yeah. First page of your answer book, you'll always keep it for balance sheet. Second page of your answer script, you will keep it for P&L. Don't write balance sheet format. Don't write P&L format. Quickly come to third page. In the third page, you will prepare notes to accounts only for share capital and reserves and surplus. Half page share capital, half page reserves and surplus. Don't try to put one more in it. Page number 4, it will be all non-current liabilities and current liabilities. Page number 5, balance sheet asset side notes to accounts. Page number 6, P&L income, revenue from operations and other income. So what if it has only 4 lines? Still leave that page empty. Page number 7, you will write notes to accounts for expenses. By doing this, the moment you see one item, you know which page to write. And when you write from there to P&L or balance sheet also, you know where is this item. So you know from page number 6, only incomes will come. Page number 7, only expense will come. This way, you will have to do less book cricket, flipping between pages. And you have one systematic manner that is said. A lot of them who find financial statements comfortable also find it little irritating because they don't know how many notes to open, they don't know spacing, they don't know the serial order rating, they don't know how to start, how to end. But they know the problems. But they have problem in presentation. Quick solution to all your presentation problems, follow this order. What if there is no PL? Then page number 2, P&L will not come. And these two pages will not be prepared. First page balance sheet, second page will be notes to account, liability side, share capital, reserves and surplus. Third page will be other non-current and current liabilities. Fourth page will be assets. So follow this order, it will save a lot of time in the examination. Don't worry about number of papers, 3 is already cut. Then talking about the last part of our financial statements chapter, this is on dividend. Section 123 and Section 124 of Companies Act 2013 talks about dividend. This 123 completely you learn it in law class, and this 124 completely you learn it in law class. What is needed in accounts, which is also there in law, is giving dividend in the year of inadequate profits or no profits. When you have profit, you want to give dividend, you can give any amount of dividend. When you don't have enough profit and you still want to give dividend, how much dividend can you give? That is told under this rules. Shall we discuss? Number 1, if you're using current year profit, there is no restriction. If you're using accumulated profits of the previous year, restriction comes. Number 1, you cannot give more than average of last 3 years. Take the average of last 3 years. You find one rate, that is the maximum. You can't give more than that. If there is dividend in all the 3 years, add dividend for year 1, year 2, year 3 divided by 3. If there is dividend only in 2 years, 1, 2, and one of the years you take 0 divided by 3. If there is no dividend in all the 3 years, then this rule is not applicable. If there is no dividend in all the 3 years, then this rule is not applicable. I hope you understood. This is the maximum rate, not the minimum rate. And the second point is that whenever you take money from the reserves for the purpose of declaration of dividend, the amount is restricted to 1/10 of PUC plus free reserves. So paid up capital will include equity, preference both. Take paid up capital, that is equity, preference both together. Free reserves, money which is available for freely distribution as dividend. General reserve, P&L, only 2. In a very rare circumstance, if there is dividend equalization fund in the question, take that also. Other than this, security premium, capital redemption reserve, debenture redemption reserve, or revaluation reserve, all of these are not considered. So what should you take in free reserve? General reserve, P&L. If in case they give something called dividend equalization fund, take it. But you will never come across that in the question. But I am covering the extreme case also. Paid up capital, equity preference, free reserves, general reserve, P&L together. You do into 1 divided by 10 or 10%. This is the maximum money that can be utilized. This is the maximum money that can be from the reserves. Are you getting this? If they give a proposed rate, you take that proposed rate on share capital. Dividend is always given as a percentage of paid up capital. You find the amount that you want to give, compare it to the maximum amount. If the maximum amount is more, if this is within the limit, yes. If not, no. Understood the second condition? Third and fourth condition read together. Whenever you take money from reserves, after you take the money, balance should be minimum 15% of PUC. So what to do? Keep 15%, take the balance. Paid up capital into 15%. So much money you should keep in free reserves. Balance can be withdrawn. Take the balance amount. Do PUC into 15%. Keep so much in reserves. Take the balance 85%. So that if there is profit in current year, add, because current year profit has no restrictions. If there is loss in current year, deduct. Whatever is the balance, that is the maximum amount that can be distributed as dividend. So what do? Do PUC into 15%. Keep so much in reserves. Take the balance amount in free reserves. add current year profit or deduct current year loss. This is the maximum amount that can be distributed as dividend. Compare this with the dividend that they have proposed. If dividend that they have proposed as an amount is less, dividend can be given. If it is more, dividend cannot be given. Questions on this has come in the exam in the past. I hope you people will ace it. Just to make you understand what is the pattern that's come in the past, I've given you one small table here which you can see to understand how many times and for under which question has financial statements come in the past. That's it. Stay the game.